Steve Ostrom with Coldwell and RosevilleandRockland.com. Today we're here with Shawn Krumpe, and he is our PennyMac lender that we use with PennyMac owned banks. PennyMac is a newer bank, and we like them because they're a broker. They're not a broker. They're a direct lender, and they're not being sued because they're a newer bank as much as some of the other places. So the topic I have for Shawn today is basically we keep hearing about interest rates changing, and people are worried. Like, if we change this much, I think we're at the lowest interest rates right now, but people are worried if it changes next week or 2 weeks, how is it going to affect their payment on the house? And even though prices are going down, how is their payment going to be affected by the change in interest rates? So Shawn's going to talk to you about that today.
It's a great question, Steve. A lot of people are worried what's going to happen to interest rates, and a lot of people still are, I think, a little concerned about home prices. And what people don't realize, I think, is the likelihood that they could go up or not go up. But what I'm going to do here today is show you the differences as far as what would happen if they do rise. We've got a loan amount here of $300,000, or excuse me, a purchase price of $300,000. A typical 20% down loan. I mean, the same concepts would apply to FHA if you only had 3.5% down. But to illustrate this scenario, right now on that particular loan rates are kind of hovering around 4.625, 4.75, which is a great rate.
Well, it's spectacular. And we've been selling for a while. This is, I mean, we don't even know how it's this low. So, I mean,
yeah. And they're not going to stay that way forever. We do know that for
Yeah.
sure. We don't know how long they're going to stay that way, but it's not going to be forever. To give you an idea here, that payment on that particular scenario with just the loan payment would be $1,251. Mm-hmm. So, and that's not including taxes and insurance, but that's just your loan payment. Mm-hmm. If rates were to go up 1%, so at 5.75, which isn't out of the ballpark. This time last year they were almost that.
Yeah.
So they were low to mid fives. Your payment would jump up to $1,400.
So that makes a big difference.
Yeah, I mean that's $150. That's half of a car payment.
Yeah.
It's a pretty decent amount.
Mm-hmm.
If they were to go back to where they were just 3 years ago, July of 2008, rates were about 6.88%. You can look that up.
Yeah.
And that rate would actually bring it up to $1,577.
Yeah.
So that's about, what is that, $325 plus, about more than just about 2% jump, roughly.
Yeah, and we talk about rent versus own and the difference, and interest rates would affect the rent versus own also. And when I started selling real estate, I remember when it got below 7 interest rate, we thought it was the greatest thing ever. Like, oh, it'll never be below 7. But then obviously things have changed now.